I know it sounds fanciful in today's market to talk about rising rates and higher rates, but we are at the end. If you open the aperture very broadly, we are at the end of the ninth super cycle of interest rates in the last 800 years. And the Bank of England did some work that showed that at the end of these super cycles, regardless of the cause, everything from the Ottomans sacking the silver mines to the bubonic plague to the Second Industrial Revolution, that in the first 24 months after rates start to rise, they rose on average 315 basis points. So you don't have to believe that analysis. We can say this time is different. But at Bain, we would call your attention to several factors that make us think that while we're not looking at the next year, 2 years, even 3 years for rising rates, we are looking out 5 to 7 years, which of course for investors is a critical period. The factors that we would draw your attention to are first, reduced capital mobility because of the challenges to globalization I discussed earlier. The second is reduced global savings. That declining workforce is declining a population that is retiring, drawing on their savings. And so this global pool of growth of capital generated largely by workers at the peak of their career. The capital generators are people between the ages of 45 and 60 whose children have grown up and moved out of the home, who are at their highest productivity, but also lowest consumption relative to their income. They generate that pool of savings. As that demographic pool changes and shifts and gets smaller, we'll see less global savings overall, or at least a much reduced growth rate on that savings. And finally, we just talked about the automation investments. The investment in service sector automation, the necessary investment to prevent an environment of stagflation as we lose workers, lose productivity, so that service sector automation we'll already see, but we'll see rapidly kicking off over the next few years. That involves not just the automation piece, but also the infrastructure piece. When you refit a restaurant to have no sous chefs, to have the preparation of whatever needs to get chopped and diced done automatically, you may have a chef, but you're not going to put a robot in a bright, well-lit room with lots of counter space. It's unnecessary. All of those infrastructure rebuilds, along with the actual equipment, will be an $8 trillion investment in the US alone. So we have three factors that are likely to limit the global pool of capital going forward. Again, there'll be pockets of capital abundance, but pockets of places where it may be challenging to get capital. So while it seems unbelievable to think about rising rates in an environment where we're at the question on everyone's mind seems to be how low can you go, it's worth at least testing that in your portfolio. If you believe that there is a possibility that capital will get more dear or more challenging to come by, it is an excellent window now to shore up balance sheets, ensure liquidity, and think about those aspects of your business while it's still easy to come by.